Market Outlook, Trade Deal Progress and Nifty50 Analysis. Moneycontrol Pro. The market's future could hinge on one trade agreement, and that's a dramatic reality. Indian benchmarks ended the week in the red, waiting anxiously for the July 9th deadline on U.S. tariffs. The Nifty50 slid 0.68% to settle at 25,461, while the small-cap index surprised by climbing almost 1% and the mid-cap index notched a 0.6% gain. Foreign institutional investors resumed selling after 2 weeks of buying, unloading shares worth 6,604.56 rupees crore. Meanwhile, domestic funds kept their winning streak alive, buying for the 11th week in a row and quietly showing where their confidence lies. On the sector scoreboard, Realty fell 2% and banks dipped 0.7%, matching the downturn in FMCG. In contrast, consumer durables soared 2.7%, healthcare and PSU Banks both jumped 2%, and IT and media each edged up nearly 1%. Across the oceans, U.S. markets moved higher, with the S&P 500 and Nasdaq Composite hitting fresh all-time highs after the Senate and House cleared Trump's reconciliation bill. But here's where it gets controversial: will that domestic surge in America withstand the imminent tariff showdown? All eyes are now fixed on July 9th, when the 90-day tariff truce expires. European and Asian markets have shown jitters, with many locking in profits ahead of the deadline. But here's the part most people miss: upcoming trade talks could reshape this nervousness into relief or renewed panic. Swing readings on the daily chart are telling a subtle story. The swing indicator has dipped to 44, not deeply oversold, but low enough to suggest the pullback might be near its end. In past corrections, that figure often plunged below 40 or even 30 before reversing, so a rebound from 44 would be unusual but powerful. On the weekly chart, a small pullback could test the 20-day moving average around 25,160. If buyers defend that level, the path to new highs remains clear. Higher highs and higher lows define the uptrend. Foreign players are leaning heavily into shorts, adding almost 30,000 contracts this week. Short covering could fuel a sharp rally as we enter wave 3 of the market's advance. In May, bearish bets peaked at 106,000 contracts. In last week's expiry, 70,000 shorts were closed, only for 30,000 to resurface. Yet despite those positions, the market has steadily made higher lows, a tug-of-war between bulls and bears unfolding slowly. Domestic institutions, the market's steadfast backers, still hold large long positions in index futures. They trim on rallies and top up on dips, proving they're in for the long haul. Their commitment has kept this bull run on track and extended the longest span above key support levels in recent memory. Sector rotation is in play, too. On the weekly relative rotation graph, financial services and private banks are weakening. Pharma shows early signs of revival, while FMCG momentum falters. IT, realty, metal, MNCs, and consumer durables are strengthening. Infrastructure, oil and gas, and PSU banks have moved into leading territory, signaling broad participation in the rally. On a daily time frame, only IT sits in the weakening quadrant at a make-or-break moment. Most sectors in lagging show improving momentum: FMCG, PSE, energy, pharma, media, while private banks and financial services remain under pressure. Consumer durables and infrastructure shine in the leading quadrant, joined by metal and oil and gas. Stocks to watch this week include Divis Lab, Fortis, Glenmark, Marico, Muthoot Finance, Nazara Technologies, HDFC Bank, Infosys, Reliance Industries, and Geo Financial. Do you think the approaching tariff deadline will spark a market fireworks show or a fire sale? And is the FIIs growing short book a warning sign or a setup for a spectacular short squeeze? Share your take and let the debate begin.